This video will help you prepare for your Chapter 3 exam. We are completing the tax return in Comprehensive Problem 3-1 from your assignments. The taxpayer is Gordon Temper. He is single and was born in 1987, so I think that makes him around 37 years old. This just means that you won't have to worry about any additional standard deductions for him. Gordon operates a food truck called Mobile Peri Peri that specializes in South African food. When he's not operating his food truck, he parks it in an office park where he also has an office and keeps his inventory. His revenues and expenses for 2024 are provided here for us. We'll come back to these figures once we start our Schedule C. Gordon also works as a part-time cook at a steakhouse, so he has a W-2 that we'll be entering information from. He also has 1099s reporting interest and dividends. Mobile Peri Peri uses the cash method of accounting and the cost method for inventory. We'll use this information on the Schedule C. His transportation log shows that he drove his truck 5,600 miles and listed 680 miles for his drive in his personal car from his office to his second job at the steakhouse. We are also given information about dues and subscriptions, travel expenses, and alimony, and we'll come back to this once we start completing the tax return. First, we will begin the 1040 by entering the taxpayer's first and last name and social security number and double checking the spelling and the figures to make sure they're correct. We'll enter the address and leave the section about the presidential election campaign blank because he does not wish to contribute. His filing status is single. There was no indication that he had any digital assets. No one can claim Gordon as a dependent, so we'll skip that section. He was not born before 1960. So the first thing we'll fill out is line 1, asking for amounts from forms W-2, box 1. So if we go over to his W-2, we'll see that he had wages, tips, and other compensation of $22,400. So back over on the 1040, we'll enter $22,400. Next, we'll look at the 1099 DIV to see how much interest and dividends to report. The 1099 INT reports interest of $31.90 with no income tax withheld. So we'll go back over real quick and enter $31.90. Looking at the 1099 DIV, we see that ordinary dividends were $5,800 and then qualified dividends are $5,500 and capital gains distributions are $1,000. From Chapter 2, we learned that ordinary dividends are taxed at the taxpayer's ordinary tax rate. Qualified dividends qualify for a lower rate or the capital gains rate, and then capital gains distributions are taxed at the capital gains rate. So let's get those over on the 1040 on the appropriate line. Okay, so the qualified dividends were $5,500. Those will qualify for a lower rate. The ordinary dividends are $5,800. So of the $5,800, $5,500 of those are qualified dividends. And then line 7, the capital gain distribution is reported, and that was $1,000. And capital gains are also taxed at a lower rate. So when we begin to calculate the tax, we've got to keep this $5,500 and this $1,000 in mind. Since the taxpayer's interest and dividends exceed $1,500, we're going to have to fill out Schedule B, which gives more specific details about where that interest and the dividends came from. So at the top, I've entered the taxpayer's name with their Social Security number. From the 1099, I could see that the interest came from InvestCorp Bond Fund, and it was $31.90. I just brought the total down to line 2, and then again to line 4. And for the dividends, I did the same. The dividends from the 1099 DIV came from InvestCorp Small Cap Equity Fund for $5,800, and I brought the total down. So it's a pretty simple form. At the very bottom, remember to answer the questions about the foreign accounts and trust. There were no foreign accounts, so we will enter no on 7A. We'll skip 7B because it's if yes, if the answer was yes here, so we don't need to put anything on 7B. And then on line 8, we will enter no. Now we need to get started with the taxpayer's self-employment income, so we will begin the Schedule C, profit or loss from business. At the top, I've entered Gordon's name with his Social Security number. The principal business is a food truck, and I'm going to enter a code from the instructions from Schedule C. You'll be given this code. The business name is Mobile Peri Peri, and then the business address. Remember, the instructions told us that the cash method of accounting would be used. G asks if the owner materially participated in the operation of the business, so we'll put yes. And asks if he was required to file Forms 1099, so we're going to enter no on that one. All right, then we'll start with our income. So we need to go back to the instructions to pick up the amount of the gross receipts. So the gross receipts from the instructions were $81,000. So we're going to go back and enter that on Schedule C, line 1. There were no returns or allowances listed, so we'll bring the $81,000 down to line 3. Now we need to calculate the cost of goods sold. And that calculation is shown here on page 2, starting with line 35. So 35 asks for the beginning inventory, which is $5,600. The purchases are $4,300, and the ending inventory is $5,000. So if you've had Accounting 1 already, then you may know already how to calculate cost of goods sold. We take beginning inventory and add the purchases to get all items available for sale. And then we subtract the ending inventory we still have at the end of the year to figure out how much was sold. So we'll go back over to the Schedule C and enter $5,600 as our beginning inventory. Then he purchased $43,000 in food. There was no cost of labor, materials or supplies, or other costs. So now we're going to add lines 35 through 39. So that's beginning inventory plus the purchases. And that gives us all the food items available for sale. At the end of the year, he still had 5,000 of those of the 48,600 in food items. So 5,000 was the ending inventory. So the difference was sold, and that will be the cost of goods sold. So we're going to take and move this figure, the 43.6, back over here to line 4, the cost of goods sold. So if he earned $81,000 from his customers and the cost of his food was $43,600, then his gross profit is $37,400. So this is the amount that he's going to have to pay his other expenses and then hopefully have some left over for himself. So now let's get into the expenses. If we go back to the problem, we see we had truck rental, office rental, advertising, insurance, food license, uniforms, dues, travel, and office expense. So for now, we'll go ahead and put in everything except the travel. We're going to have to check out that travel expense and make sure that it all qualifies as business expenses. But in the meantime, we'll go ahead and get the other figures in. There was $1,000 in advertising. The insurance was $3,400. The office expense was $400. The vehicle rent, he rented his truck, so that's $24,000. His rent for his office was $8,600. That's a lot of money in rent. Taxes and licenses, $500. Okay, and so we needed to kind of wait on the travel and maybe some meals. So let's go back and look and see what it says about the travel. It says Gordon provided a transportation log. Now there's a difference in transportation and travel. Transportation is just going from place to place as a part of your work. Travel usually involves an overnight stay. So we'll look at both of those separately. Gordon provided a transportation log that shows that the truck drove 5,600 business miles in 2024. The standard mileage rate for 2024 is 67 cents. So he should be able to take transportation or car and truck expenses of 5,600 times the 67 cents for the standard mileage rate. He also had total mileage of 680 in his personal vehicle from the Mobile Peri Peri office to his second job at the steakhouse. He did not provide mileage from his apartment to or from either work location. So for his personal vehicle, if he goes from one job to the next, that mileage is deductible. However, any mileage from his home to the office or from his office back to his home, that's considered commuting, and that is not deductible. Normally, he would get a deduction for 680 miles driven from job to job at 67 cents a mile. Now, when I was checking out the answer key, I could see that they did not give him any transportation expense. And I had to figure out, what was going on there. So I found an explanation in the answer key that said, since he did not provide mileage from his apartment to or from either work location, even though he had a transportation log for his business miles and his total mileage for his personal vehicle, he is not entitled to any transportation expenses. So if you take transportation expense, the IRS really wants detailed transportation information to verify that the deduction that you're taking is correct. So we're just going to forget about all that information because just because he did not have a mileage log for his commuting, he was not allowed to take any of his transportation expenses. His $100 dues were for a subscription to Food Truck Monthly, which is a trade magazine, and it is related to his business, so that is deductible. He had travel expense of $1,600, and that was for a trip to Steamboat Springs, Colorado for a one-day seminar on South African cuisine. He spent one day at the seminar, and then he went snow skiing for 2 days before returning home. His airfare was $400. His lodging was $300 a night for 3 nights, and his meals were $100 per day. So let's try to figure out what's going to be allowed here. He spent 2 days snow skiing and only 1 day at the seminar. Now, if he had spent more time at the seminar than he did snow skiing, he could have deducted the $400 for his airfare. But since he spent more time skiing, he's not going to be able to deduct that airfare at all. His lodging was $300 per night for 3 nights, and his meals cost $100 per day. But he was only there 1 day on business. The other 2 days were for pleasure. So he can deduct $300 for 1 night and $100 for meals. However, that $100 is limited to 50%, and it's limited by the IRS. You can only take 50% of your meals, so he can deduct $50 for the meal cost. His uniform was a white chef's coat and puffy chef's hat that cost $200. You can deduct uniform expense if it is not for everyday wear. So it is a kind of a specialty item, so he can deduct that. So now let's get those figures over on the Schedule C. For transportation, we're not entering anything, unfortunately. The solution said that is not allowed. And then over here on travel, we're going to deduct the $300 for lodging. Remember, he gets nothing for his airfare. The deductible meals will only be $50. There is no specific line for his, I think the chef's coat and the dues, the uniform. So we're going to list that under other expenses, and we're going to explain that on line 48. So we'll go to page 2 down to line 48, and we will enter the uniform expense. That was $200, and then the dues were $100. So that's a total of $300 that we're going to enter over on 27A. Okay, now we're going to add all of our expenses up. The advertising, the insurance, office expense, the rent for his truck, the rent for his office, the taxes, the travel, the meals, and the other expenses. And we add those up, we'll get $38,550. So his tentative profit is the $37,400 gross income or gross profit less his total expenses of $38,550. So his expenses here are greater than his income. So he has a tentative loss of $11,550. So we're going to bring down the net profit or loss here on line 31. Usually, self-employed individuals also have to pay self-employment tax, and we'll get to that a little bit later. And the self-employment tax is assessed on this net income or net profit figure. He has a loss, so there will not be a Schedule SE or any self-employment taxes. Line 31 says, if a loss, you must go to line 32. And 32 says, if you have a loss, check the box that describes your investment in this activity. Well, Gordon has all his investment at risk. The next step is to take the loss of $11.50 and move it over to the Schedule 1. The Schedule 1 is where all additional income and adjustments to income are recorded. I've entered Gordon's name and his Social Security number at the top, and we're going to go down to line 3 and enter that negative $11.50 for the loss from the Schedule C. Next, let's take a look at his alimony information. It says Gordon was divorced in 2017. Now that's important because that is before December 31st, 2018, which means that the alimony is a taxable event. If the divorce had occurred after December 31st, 2018, then we would not even report it at all. But his ex-spouse, Tanya, pays him alimony of $300 per month. So that is going to be 300 times 12, which is $3,600 a year. So over on the Schedule 1, alimony received, we're going to have to enter the $3,600. And then we're going to enter the date of the original divorce, and that was 1/1/2017. Okay, now let's look at the other areas involved with this divorce. His wife has custody of their 5 children. One of the children, age 17, lived with Gordon for 5 months during 2024, and he estimates he provided more than half of her support. Well, to be considered a dependent, Buffy would have had to, of course, lived with him for more than half the year. So she only lived there for 5 months, even though he did provide more than half of her support. But so in this case, he cannot claim Buffy as a dependent. So now we'll go over and finish up the Schedule 1. The total will be, let's see, $3,600 less the $11.50. Okay, will be $24.50, and we're going to move that over to line 8 on our 1040. So over on the 1040, we'll find line 8, and it says additional income from Schedule 1. That'll be $24.50. So now we'll complete page 1 of the 1040. We need to bring down the $22,400 in earned income down to 1Z. And now to get the total income, we'll add lines from 1Z to 8. And that will give us $34,840 in total income. We had no adjustments to income from Schedule 1. So the adjusted gross income is $34,840. The taxpayer is single, so $14,600. Remember, he could not claim the dependent, so he can't file head of household. The standard deduction is $14,600. There's no qualified business income deduction, so the total deduction from income is $14,600, which will give us taxable income of $20,240. Now it's time to calculate the tax liability. We've got our taxable income. That's as low as we can get our income. So it's time to go to line 16. And before we do that, we need to remember that included in the $20,240 is income that should be taxed at capital gains rates. So before we can go to the tax tables, we need to subtract out the qualified dividends and the capital gains distributions. These are going to be taxed at a lower capital gains rates. So $20,240 less $5,500 less the $1,000 capital gain distributions gives us income of $13,740 that's going to be taxed at ordinary rates. So we will go over to the table to $13,740. That's between the $13,700 and the $13,750. And the income on the $13,740, which is taxed at ordinary rates, is $14,015. So we know that the tax liability is at least $14,015. Now, for taxpayers who have taxable income of $20,240, the capital gains rate for a single taxpayer is 0. So there is 0 tax liability on the qualified dividends and the capital gains distributions. So the only tax we have is the $14,015. So we'll bring that figure down to line 18 since there's no taxes from Schedule 2. There are no additional taxes from Schedule 3, so we'll bring the $14,015 down to line 22, and then the total tax will come to $14,015. Now we need to see what Gordon's prepayments were. So we'll go back over to the problem, to the W-2, and from his W-2, his $22,400 earnings, he had $1,920 withheld in federal taxes. He didn't have anything withheld from his 1099 INT or the 1099 DIV. This was his only prepayments. So when we go back to the return, we'll enter 1920 on line 25A. That's the payments withheld from the W-2. And that will go down to, let's see, there were no credits or other additional payments. So that's just going to go all the way down to line 33. So he has prepaid $1,920 in federal income taxes, but his liability was only $14,015. So he gets a refund of $505. On your Chapter 3 exam, you won't have to worry about any capital gains taxes. It'll all be ordinary income. So you will see capital gains on some future tax returns, so make sure you know how to tax those. But for Chapter 3, you won't have to worry about that.